You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, guys, welcome back to the Young Investors Podcast. We are episode 161, and Merry Christmas, everyone, and Happy New Year, I think, as well, if I've got my times right. Will this one be coming out on the potentially the 1st of Jan?
Yes.
I'm scrambling now. I'm scrambling to look at it.
It's either New Year's Eve or New Year's Day.
It should be New Year's Day.
I think it's New Year's Day, yeah.
Well, we'll keep this one short and sweet so you don't have to listen to us too much while you're trying to cure your hangover. No. Merry Christmas, Happy New Year to everybody.
Yes.
This episode is because we're trying to have a week off because we are probably also recovering from a hangover right now as well as you listen to this. So in this episode, of course, we value the consistency of the podcast, and I'm sure you guys do as well. So we still wanted to get a podcast out for you guys for to give you something to listen to while we have a week off. So we're doing a Q&A podcast. We've got a stack of questions. So I'm not quite sure how long this will go for, but I guess we'll see. And got my good buddy Hamish here. Hey, how you doing, Hamish?
I'm doing well. It's weird to because we recorded 2 podcasts in the same day, so we're
double stacking.
It's weird to do the intro kind of twice. Like, oh, hello again.
It is. Yeah, it's like, just stopped talking to you 5 minutes ago. Yeah. It's like the cricket. We've had the morning session and we've just gone and had lunch.
Yeah.
And now we're back for the second session, the afternoon session.
Exactly right. No, you guys came through. We've got a lot of questions. So, we'll kind of just work our way through them. A lot of different questions, some kind of, interesting, maths related questions around discounted cash flow and that sort of thing. And then a few others. I'm looking through here. There's a wide range of topics we're going to get through. So should be good.
Yeah, a lot of people asking us about the discounted cash flow. So I think we'll make that the first one we go through, and we'll take a bit of time to actually talk through that, because I feel like that's a trouble point for a lot of people that are trying to learn all this themselves. And for me, it was definitely a point where I was like, gosh, this is hard to understand when I was trying to wrap my head around it. So make sure we do that, and lots of questions. So let's just jump right into it.
Yeah, today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker, or you can do it manually through Excel, or just one by one manually as well. And once you do that, it will track all of your gains. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you're holding foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used to track performance, diversity, as well as used to calculate things for tax, such as capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, try it for as long as you want, or you can also sign up to a paid plan and get 4 months off a yearly subscription if you use our link. So go check it out if you're interested. Good way to get started on the in the new year, tracking your portfolio accurately with Sharesight. Yep.
Yeah, absolutely. All right. With that said, let's get started. And so I kind of just distilled this down into one question because there was a lot of questions which are kind of nuanced into a particular part of the discounted cash flow model or this or that. But I think the question that we'll try and answer is, how do you do a discounted cash flow valuation on a company?
Yeah.
And it's good. We won't go into like a full example with numbers and this and that and calculate this because it's a podcast. It's an audio format. But what we'll do is we'll kind of just explain the steps, the mindset, the steps that you need to go through, and hopefully understanding the steps. Us kind of talking about it can give you an understanding of why each step of the process happens and how that's useful in. It's not a perfect method, but putting an estimate on what a company might be worth. So you go on, Hamish.
All I was going to say is I think a good idea before we get into what is a discounted cash flow, I think a really important question to answer is why would we use a discounted cash flow? Like what's the purpose of it and what does it do? And it really stems from this core idea which Warren Buffett relays over and over again, which is that the value of a business is the total amount or the sum of all of the profits, the cash flows that the business produces from today until, I think Buffett says, until Judgment Day, or until the business is no longer around, discounted at an appropriate rate. And just logically, rationally, that makes sense, right? An investment is simply an outlay of money, and you expect to get more money back. So thinking about, what a business is worth, we can think of it as what we're going to get back from that business. And that idea of calculating all of the cash flows and then discounting them back at an appropriate rate, the mathematical formula that allows us to do that is a present value of discounted cash flows. So that's kind of the mathematical way that we approach that.
The kind of picture that I put in my head to make it all make sense for me is that I'm at a market, and this vendor has a machine, and what this machine can do is it can print money. So I have to try and figure out how much am I willing to pay for this machine in front of me that can actually print money, but it prints money at, it will grow how much money it will print over time, but I can't really influence that. It's going to print some money and it's going to need some repairs and that sort of thing along the way. So how do I evaluate how much I should pay for this thing that can print money? And eventually, in say 5 to 10 years, I will sell that machine. And that's kind of the process of the discounted cash flow model, is figuring out how much to pay for this machine that will sell in 5 to 10 years or something like that. All right, where should we start? I guess step number 1 of discounted cash flow is finding the current cash flow, right?
Yeah. So we need to kind of start from somewhere. And, if you can think about the discounted cash flow as coming up with a picture of the total amount of cash flows in the future, one of the most common approaches to that is to start by figuring out what level of profit does the business produce today, or let's say over the past year, and then going from that point, figuring out where we are today, and then, growing that over time or figuring out from today what's going to happen to cash flows in the future. And with that current cash flow, there are a lot of different ways that people calculate this because, there's the official net income or net profit figure that's on the income statement. So you could just take that, and that uses accrual accounting and calculates all the revenues that the business produces, all the expenses that were used up by the business, materials that were used up by the business during the period, and comes up with a profit figure. That's not the only way you can go about it. There's the common kind of Wall Street way of starting a discounted cash flow is using what's called EBIT, which is earnings before interest and tax. So that's that profit figure, but we're excluding interest payments and tax, or EBITDA, which excludes interest, tax, but also non-real depreciation charges and amortization charges. And then there's kind of the value investing Warren Buffett approach, which is to use a cash flow figure. So instead of looking at the profit figure that appears on the income statement, looking at the cash flow statement and looking at how much actual cash came in and out of the business, because that's different from the net income figure. And one of the, I think, most obvious examples of how they differ is depreciation. So on the profit figure, say if the business has a machine, you can depreciate that machine over time, which essentially is a non-real expense that represents that machine is breaking down over time. Whereas if we look at the cash flow statement, that won't appear because that's not a real cash in and outflow. They don't pay depreciation. That's not a real expense. But what they pay instead is they actually pay to fix the machine over time. So there's kind of a lot of different ways you can start with this starting cash flow. We kind of align with looking at cash flow because it gives us a more raw, accurate picture of money coming in and out of the business. But there's a number of different ways that kind of people go about that.
Yeah. And so the number that we end up with at the bottom of our cash flow statement, I guess, after we calculate it, is free cash flow. And that's, again, we can deliberate, but that's kind of, if I was new to investing, I would say, look at the free cash flow. Because the free cash flow is essentially all of that money that's coming into the business, minus the money that's going out, the cash that's going out in order to either maintain or grow the business. Now, technically, and I'm sure you'll talk about this a little bit more, if we can refine that a little bit more into what Warren Buffett would say is owner's earnings are, then we should use owner's earnings. And what owner's earnings is just all that money coming into the business, all that cash coming in, so cash flow from operations. And then we essentially just take away just the maintenance capital expenditure. So that amount of money that just goes into making sure this cash flow generating machine, this monkey that I'm talking about, this robot in front of me that can just spit out cash, we're just factoring in the money that is used to just maintain that machine, just to keep it going. But in reality, I think that cash flow for owners, or as you call it, Hamish, or owner's earnings, or whatever you want to call it, is a little bit harder to actually nail down, because it's not just a standard number that's written down on the financial statements. It's something that you have to actually calculate or estimate yourself.
Then you're really trying to make an estimation of what excess cash is left over after the business just maintains itself. So at the end of the year, if it just got back to where it was at the start, if machinery was in the same condition, if they had the same buildings, if all the employees were paid, if inventory was topped up, if all of that remains equal at the end of the year, if we get the business back to where it was, what cash is left over that can then be either delivered to us directly as, say, a dividend, or reinvested to actually grow the business, make it more valuable. So from that point, we kind of get a starting cash flow. And then the most common approach is to apply a growth rate to that cash flow over time, which is, of course, I think the most challenging part of not even just valuation, but I think of the entire investment process, which is coming up with an estimate of what is reasonable for the growth of profits in the future. For some businesses, that's going to be very small. It might even be flat for some businesses. Some businesses might not have the ability to grow anymore. They just produce the same amount of excess profit every single year going forward, and that's what we should expect. But for most businesses that we're kind of interested in, growing, compounding businesses, we're trying to make an assessment of if they take that excess cash flow and they reinvest it into new buildings, into new products, into new retail locations, whatever it is, what will profits be in the next year, and then in the year after that, and then in the year after that, and will they grow at a constant rate, and what will that look like over time?
Yeah, exactly.
And I mean, that's definitely the most challenging part.
That's the game.
That's the game. And you have to be extremely careful, I think, in this area, because you don't want to overestimate. And a lot of the time, it's exciting to think about what a business could do. What could this business become? Could this small retailer become let's say they're selling a small shoe retailer. Could they become the size of Foot Locker or something like that? And it's exciting to think about, if they build this many stores, this is, I'll make this much money on the investment. But you really have to think about what is reasonable. And what is, I like to think of it as not what is possible, but what is the most likely outcome, or what would you bet your money that 80-90% chance that's going to happen, or even higher maybe.
Yeah, that makes sense. You don't make money in investing from thinking oh, what if it could do this? What if it could do that? You make money in investing from being right or looking at what is most realistic. So yeah, try not to get swept up in, oh, I heard someone on TV say they could grow at 60% annually for the next 10 years. That is very, very, very hard to do. That's right. And there are ways that you can actually find out, well, how do we grow these cash flows? You can look at, well, how does their industry grow? You can look at how has this company been able to grow, say, over the past 5 years or 10 years? If you see a company that's grown their profits or grown their cash flows at 10% pretty much every single year for the past 10 years, and you do your research on the company and you see, oh yeah, they're implementing the same strategy. They're going to open about the same number of stores, maybe a few more stores each and every year for the next 10 years. The same strategy is what they've been implementing in the past 10 years. Then you might say, okay, I think it's reasonable to expect that growth can continue. So you can look at, you look at the industry, you look at the company, what they've been able to do in the past. And at the end of the day, this growth rate is not like add 2 and 2 together and divide it by 5 and then plus the company's cash flows. And then there you go. It really does come down to how in depth you go with the business and how much you understand it, understand the industry, understand what they've been doing, how successful they've been. The more you know about the company, the more confident you'll be able to you'll feel to be able to put a growth rate on it and grow those cash flows out into the future.
Yep. Exactly. So then kind of what you will do is usually it's kind of like a 2-step process in a discounted cash flow. The first is we have this kind of reasonable period of projection, which is usually 5 or 10 years, where you think that you can visibly see what cash flows are going to grow at over that time. Most common is 5 years, but a lot of people look at 10 years as well. And you will calculate the cash flows in each of those years. And then after that, because of course we don't just want the next 10 years of cash flows, we want an estimate of the total amount of cash flow. We then have to add another step, which is to add a terminal value. And that terminal value is a mathematical way of calculating all of the cash flow that the business will produce after the 10th year. And beyond, 10 year or 5 years, that's what we call beyond a reasonable projection horizon. So we want to be extremely conservative. Usually you're projecting 0% growth from the 10th year or 1% growth. Usually it's recommended to go no higher than long-term GDP growth. So in other words, it's unreasonable to expect that a business is going to outpace GDP forever, which is, that mathematically doesn't make any sense. So usually you're being very, very muted after the 10th year, maybe 1% per year growth into infinity, essentially projecting that the business goes through a growth period, matures, and then is just a steady, stable business. So then you can kind of add that terminal value. But one thing I just remembered, and it's important to kind of keep this in context, is all of this hinges on the idea that we're first looking at businesses that have deep competitive advantages, because you can't project forward and expect a business to survive for 10, 20, 30 years if it doesn't have deep competitive advantages. So this is kind of the last stage of an entire analysis process that, you need to make sure that you're kind of going through.
One of the interesting things that I learned this from Monish Prabrai from reading The Dando Investor, the way that he explained kind of the idea of terminal value and really this whole process, I found it really resonated with me. So say we're looking over a 5-year time period. He says, okay, so we're looking at all of the future cash flows of the business. So we start with our current cash flow. We decide how that's going to grow into the future over, say, the next 5 years. So we'll say, okay, maybe they can grow cash flows at 10% each year for the next 5 years. So we grow at 10 years, then 10 years, then 10 years, then 10 years, then 10%, 10%. 5 years out into the future. And then the way that Monish describes it is he goes, okay, after 5 years, imagine you're going to sell the business. So you're going to get this big, chunky, one-time cash flow from selling the business. And that's how he kind of describes the terminal values. Like, okay, so you have to imagine while you hold this business, you're going to, get the cash flows as the owner of the business. And then once you've got those cash flows over a 5-year period, you're going to go stick a for sale sign on the lawn, you're going to sell it. And what are you going to sell it for? And I think he recommends for most businesses to be conservative. You sell them for, say, 10 to 15 times that year's free cash flow. I don't know if do you take a different approach to that?
Yes, there's a number of approaches again when it comes to terminal value. There's kind of the exit multiple, which is what you just described. So you project.
There you go. I didn't even know it was called that.
So exit multiple is kind of what it sounds like. You're projecting that you can sell the business at a particular price multiple to their earnings at that point. There's a perpetual model, which is what I use, what you were describing. That's what I was describing, where you estimate that you don't sell the business, that it continues to grow at a steady rate. Of maybe 1 or 2%. That's the perpetual method. And then there's other methods, relative valuation method. There's a number of them, and different people use different methods. So it's not there's not one rule that is set in stone as the right way to approach it. There's kind of a number of different ways you can go about it. And I did a video on the different types of terminal value, and they all have pros and cons. So
I have to check that out.
Check that out if you're interested. But
and then I guess so we've started with our current cash flow, and we've grown it out 5 to 10 years into the future based on the growth rate that we learnt because we studied the business for months and months, and we feel confident that it can do what we think it can do. And then after that, we have added a terminal value. So we've got the cash flows from owning the business using my exit multiple. We've also got the cash flow from selling it in 5 years' time. And then what we have to do is we have to try and we've got our numbers there. This is all the cash flow that business is going to generate for us as the owner during the time period that we own it. Now, how much is all of that cash worth to us today? Because of course there's a time factor. Yep. There's a time factor. So the profits that are generated in 5 years' time will not be as valuable to us as the profits that are generated next year, because we have to wait 5 years before we get them, whereas we get next year's profits next year. That's pretty cool.
Yep.
So there's this time factor, and this is something that's quite difficult to understand at first, but you have to then discount this is the way I do it. You have to discount the future cash flows based on, say, what return you are expecting to achieve. So for example, I always just use 15%. So you can say, okay, next year, if I want to achieve 15%, I'll discount next year's expected cash flows by 15%, and then you do that each and every year. So progressively, as you go further out into the future, the value of that year's cash flow is less than the previous year because it gets further and further away from you, and you also discount your terminal value. And then after I don't know, we're kind of skipping to the next point. And then after we do that discounting of future cash flows, then we can simply so you'll have the current value of future cash flows from doing your discounting, and then you add them together, and then that is the present value of all future cash flows.
Mm-hmm. Correct. Yeah.
Anything to add on that one?
Yeah, the only thing I will add is when it comes to discounting, again, there is a lot of different ways that people approach this. If you go, so like what I learned at university and what traditional financial institutions will do is they will discount based on the cost of capital. So based on the cost of the money that the business is using in order to fund their operations. So that's usually a combination of debt. So they've taken on some debt and equity. So what's the cost of those two things? That is extremely different to how a lot of value investors approach it, which is we think of it from as if we're buying the whole business. In that case, we're simply thinking about our personal opportunity cost. Right. So if I invest in this business, I obviously can't put that money somewhere else. So what am I giving up? And that will usually mean we set a personal benchmark of say 15% or 10%. Which allows us to see what the cash flows are worth given that if we invest in the business, we can't put that money somewhere else. So those are kind of the two main ways, but even within those two ways, there's a lot of variation on how people kind of approach reaching the end results.
Yeah, and if you watch a lot of YouTube videos on discounted cash flow, everybody's going to do things slightly differently, which is actually quite demoralizing because you're just trying to figure out how to do this method, and then everybody says something different. One resource I think explains it quite well is Monish Pabrai's book, The Dando Investor.
Yeah.
I think that actually explains it quite simply. And uses the analogy that kind of I've been talking about, where you buy the business now, you're going to receive cash flows as it grows. You're going to receive cash flows for 5 years. And then in 5 years, you're going to sell it. You're going to get a big chunky one-time cash flow. And then you want to achieve 15% returns every year. So discount all of those future cash flows by 15% annually. And then once you've done that, you've got you add them all together for the present value of all future cash flows. So then once you do that, that is what people would call the intrinsic value or the sticker price of the business, right?
Yep.
You're trying to, this whole process, you're trying to figure out how much money do I pay for this business to make sure that I get good returns through my investment. And what you've just done is you've actually estimated, once you own this business, how much cash is it going to produce over time? How much can I sell it for? Then I'm going to discount it back to what it's worth today. I'm going to add it together, and that is what I would be willing to pay for that business. Because if I can buy it for that price by adding all those discounted cash flows together, then I know through that calculation process that I am likely to get 15% returns per year if, for example, in that approach. However, there's one fundamental final step, which I think I'll flick it over to you, Hamish, which definitely needs to be considered. That's not the end of our story, I guess.
And this is over 100-year concept that I think started with Benjamin Graham, which is the concept of a margin of safety. So even after we get to intrinsic value, what the business is worth, we don't want to pay intrinsic value. We need to allow for a couple of things. One is just the randomness that is the economy and things that happen, things like the pandemic that just come out of left field and hurt businesses, make their cash flows smaller than you would have projected, just things that you can't predict. And the other thing is, of course, errors in your valuation. So you, of course, you may overestimate, even if you're trying to be really conservative, you may overestimate what the business produces. So we want to pay, well, a lot of people target a 50% margin of safety, which essentially means you're paying 50 cents on the dollar of intrinsic value. And that's kind of that's the concept of margin of safety, paying far less than it's worth, so that even if a pandemic hits, even if you're wrong in your valuation, you're still likely going to make a return close to, if not higher than, your benchmark, whatever return you're targeting.
Yeah, the simple way that I go about how I conceptualize this step is that through this process, all that we've talked about so far, what we're trying to do is we're trying to predict the future. And whenever you start talking about predicting the future, I think most people, if you said, I'm trying to predict what's going to happen in 10 years, if you just went and said that to someone, I think that someone would probably laugh at you and say, good luck. And that's a big part of this approach. We have to realize that we cannot predict the future. We can do as much heavy lifting in terms of research as we possibly can, but there are just things that happen out of left field which can sting us. I mean, nobody saw nobody saw 2020 coming, right?
No.
Or COVID-19. Nobody saw that. So things like this happen. And so the best way around it is when we get to our intrinsic value, we add together all the discounted future cash flows. We go, you know what? Things can go wrong. I can be wrong. The future can be messy. The business could change slightly. I don't know that this intrinsic value is going to be 100% correct. And so from there, you need to give yourself a buffer. And look, the best thing that I guess, if you give yourself a buffer and you are actually pretty right, then you're going to, in fact, end up making better than 15% returns per year, if say that's the number that you go with. If things just go as you predicted, then by having a margin of safety, you are going to perform exceptionally well. However, if things go badly, if something happens like another COVID-19 in 5 years' time, then because you put that margin of safety on the business before you even bought it, then it's likely that you will still do very well by holding the stock, even if something goes quite amiss.
Yeah. And I think a good kind of caveat, final summary to this is that just because a business produces cash flow or has the ability to in the future doesn't mean that we can reasonably project forward, right? I think there's very, very limited cases where an asset produces cash flow where it's reasonable that we actually can project forward. I think real estate is a good example where, in most circumstances, rental income, for example, and the expenses related to real estate, they're relatively stable over time. You're not expecting, massive swings in how much you can rent out a property for. So you can come to a very, very reasonable expectation of what you're going to get back from that property in the future, unless you're making projections about what people are going to pay for the property. Then you get into a little bit more speculative side of things. But especially when it comes to businesses that don't produce cash flow, that are new businesses, even high growth businesses that are moving really fast, they're very, very challenging to project forward. And that's where you've got to be careful. That's where, there's thousands of businesses on the stock market, and there's people analyzing all of them, regardless of how new they are or regardless of how speculative they are. And that's where you've got to have the temperament to say, I actually can't project forward in this business. I actually don't know what's going to come for this business. So that's kind of the big caveat to all of that, I think.
Yeah, definitely. No, I agree. But that, I guess, is the discounted cash flow model. So recap, should we do a recap?
Yeah.
So first step, we've found the current cash flows. Second step, we've grown the cash flow out into the future, say 5 years into the future. Third step, we've added a terminal value. You can think about, if you go with my approach, you can think about that as what are you going to sell? What are you going to be able to sell the business for? Because we're going to hold it, then sell it in the future. Then fourth, we're going to discount all of the future cash flows, including the terminal value. And then fifth, we're going to add the discounted cash flows together. And then sixth, that'll give us our intrinsic value. Then sixth, we're going to take a margin of safety. And that is the discounted cash flow model. What a beast.
Yeah.
What a beast.
It's a complicated field. And honestly, I feel very grateful that I did do a lot of discounted cash flow at university, because it's hard to wrap your head around. If you're thinking, what the hell is time value of money? What is discounting? You're not alone. I mean, it is a complicated topic to understand. And it's one of those things where you just need to do it a lot. And then you kind of wrap your head around it. Then you go, okay, I'm starting to understand how we think about business value, but it's complicated. But as I said, maybe I said this might have said this on the previous podcast, but there's a lot of free resources out on the internet. So you can, there's a lot available to you if you want to learn more about this topic from us, but also from, other creators and other channels as well, like Khan Academy, for example.
Yep. I don't know what I'm sure you've done a video on this on your YouTube channel. If you just type in from my channel, if you just type in intrinsic value of a stock, new money into YouTube, the first thing that pops up should be the video that I make, which is a full example, and it's got calculations and everything if you wanted to learn more. But I'm sure you've done a video as well.
Yeah, I've done a number of videos as well.
Do you know what yours might be called?
Probably something.
You've probably
similar.
done a few.
Yeah, just search the same thing. I've done a number of examples as well. So yeah, just something similar. Intrinsic value, Hamish Hodder. Something should come up for you.
Cool. And that's it. So that probably covers like 80% of questions, just talking through that. But I mean, we did spend like half an hour on it, which I think was good actually. That was quite good. So we'll leave discounted cash flow now, and we'll get into some other questions that you guys have sent in. And I'll start with this one. Gents, great podcast, and thanks for another great year. Oh, thank you very much. We've enjoyed it. It's been good. It's been a great year. Plenty to talk about this year in the stock market, that's for sure. Have you both ever considered doing a YouTube series on the most famous / feared / ruthless / successful global stock market investors and their life stories, almost like a regular doco series to a point? That would be pretty cool, wouldn't it?
That would be pretty cool. Yeah, I think I don't know. Like I always have this as a kind of creative on YouTube. There's always these ideas of these insane like big projects that we could do, or series, and yeah, I mean I've certainly thought about doing a larger series, more in depth. Look into some of these investors, for example, or certain businesses. It's not something I've done. I don't think I've really done so far. I've done some videos occasionally on kind of looking through Buffett's Berkshire Hathaway letters and Nick Sleep and that sort of thing. But yeah, I think that's a good idea. Yeah, I think that's something that is kind of there's not so much of that on YouTube at the moment around really going deep on some other kind of big investors. So yeah, I've considered doing that.
It would be cool. It would be cool. And I think maybe next year when I've got some assistance, I want to do more like almost make it feel like a bit of a mini doc. And I think that'd be really interesting going into why some of these successful investors have become so successful. Obviously, I've done plenty on Warren Buffett and such, but even looking at some of the other ones, which maybe don't even follow a value investing approach, but have still found incredible success doing, following their own strategy, whether it's investing in like distressed debt or something like that, or, in the options market or finding edges here and there. Honestly, it would be great as well just for us to increase our own kind of understanding of how people have seen edges in the stock market and how they've done it. Even things like arbitrage. I'm sure there's been some very successful arbitrage investors in the past. That would all be very interesting. Yeah. So I think I might do something like this in the future.
Definitely.
But yeah, it's always just a matter of time and resources and that sort of thing, isn't it?
Yeah, exactly. Yeah.
Yeah.
All right, I'll ask this next one to you. Can you talk about the hidden costs in investing and their long-term effect?
Yeah. So yeah, there are plenty of hidden costs. They probably should factor them all in, but I tend not to think about them too much. But like the classic example is a brokerage. What you pay for brokerage, because of course, you might be looking to invest $1,000, but if you've only got $1,000 and brokerage costs $10, then you're only investing $990. The best way around this is just to, especially if you say dollar cost averaging, is to save up to have a substantial amount of money to invest in, say each quarter or something like that. Because you're right, if you are not on, say, a brokerage free site, then if you're buying stocks like every day or every week, then a lot of you will be hit quite hard by brokerage fees. Can you think of other ones, Hamish?
I think the biggest hidden cost that most people don't think about is currency. I think that, and I mean, it's a bit, not to go back to Sharesight, but it's why I really do get behind Sharesight. And I think it's a fantastic resource to get an accurate picture of your returns, because especially if you're investing in international markets like we are in Australia, investing in the US market, there are big swings in currency that are not predictable. I don't think it's reasonable to expect that you can reasonably predict what the exchange rate is going to do and how that's going to impact your investment. But it certainly has a big impact. I think I've spoken about a couple of times. At one point between 2020 and 2021, my portfolio had a negative 10% currency impact.
Yeah, it's the same,
which is and I'm mostly in the US market, so that's mostly between the US and Australian dollar. But if you're not tracking that, that's a lot. 10% is a lot, and the market did go up significantly during that period. But it was still a big chunk out of your investment return. So I think that one is hidden for a lot of people.
Yeah, that's a good point, actually. If you had a negative 10% currency return and then you're looking at your US portfolio and it's gone up 10%, you say, all right, I'll take my profits. You haven't actually gone anywhere.
Yeah.
You've actually got a 0% return. You've gone nowhere. So that's a very good one. I mean, there are other hidden costs as well. The classic one, which applies to most like managed investment products, is of course fees.
Yeah.
for example, like even superannuation, your retirement accounts, like that gets managed by a super fund. There are super fund fees, and there are even long-term studies of like how much that actually costs you, and it's quite a substantial amount. It's gotten worse over time, I think, especially with superannuation, as they just figure out that, wow, this is actually quite profitable. Let's take more and more fees. But that's always something to look at. When you're buying an ETF, there's a management fee. When you're buying into a mutual fund, there's a fee associated. Superannuation fund, always fees. So you just have to be on top of that. But yeah, I think all of these are small costs, but costs that are probably worth paying attention to, especially when you are early in your investment time frame, your investment horizon, because obviously you're going to compound the money you do invest at, say, I don't know, 10% per year, 15% per year for if you're young, potentially 30, 40, 50 years into the future. So even a small amount of money taken as a fee, as opposed to that money being invested in the stock market at an early time, can make a substantial impact in the long run.
Yeah.
Obviously, if you're like 65 and you're getting charged a brokerage fee, that's not going to make too much difference. But if you're like 18, then that might make a more substantial difference to your long-term gains, I guess.
Yeah, and I think, just an example that I know off the top of my head, because it's quite astounding, the difference between a 10% return and a 12% return over a 40-year period. So you can imagine maybe the 2% is a management fee, or maybe it's brokerage, or maybe it's a combination of things. The difference between just 10 and 12% over 40 years is double your portfolio. So it's the difference between having, let's say, $1 million versus 500,000 at the end, which seems crazy. It seems, how's that even possible? But 2% compounded over a very, very, very long time is a lot of money. It makes a big difference in your portfolio. So, some of those things, 2%, it stacks onto the next 2%, which stacks onto the next 2%. Yeah, and some of those things you can't predict or remove. I think currency is probably one of those, except for having currency in multiple countries to kind of diversify yourself. But some things you can. You can look into the management fees for your superannuation fund, for example, or the ETFs you're invested in, or you can look at different brokers and see if there's a better way that you can invest your money to reduce some of those costs.
Yeah. All right, should we move on to the next question?
Yeah, this one should I read it to you? It's kind of targeted at you, so I feel like I should read it to you.
Oh, okay, go for it.
Hey, new money. I'm also here. You can. No, I'm just kidding. Hey, new money. I'd really love to learn how to value a small business. I have quite a few business owner friends and a background in finance. I think you could bring a lot of value by helping value their businesses while starting a consulting business of my own at the same time.
Oh, yeah.
I've built different Excel models in school, but they were more focused on large corporations using dividend data. And I'd like to learn something for car washes or gas stations, or even small Shopify type businesses.
Right. So people that have started a Shopify store.
Yep.
Well, I got to be honest, I have not done this before. And maybe there's somebody that specializes in small business valuation, and they're probably going to go, no, Brandon, you're so wrong. But I don't think personally that it changes. I don't think that the process changes, whether it's a large business or a small business. I think at the end of the day, the valuation process, the discounted cash flow process that we just spent half an hour explaining, I think that applies to any business.
Yeah.
To see whether you want to, I guess, I don't know, there might be some differences, because I understand that, if you're looking at terminal values, and you're trying to, say, sell this business in 10 years' time, I believe that when it comes to private business, you can't sell a private business for as much. Generally, I think the averages say that. So maybe you have to reduce your terminal kind of multiple. But I don't know. But I think the process is the same. You want to have a look at what the business is producing in terms of cash, and you want to look at the previous data, and you want to try and estimate how the cash flows will grow into the future. And then you want to try and put that terminal value on. You want to discount all those cash flows based on the return that you would like to achieve by buying this business. And then
Better way that you can
you find the intrinsic value of the business, and then you want to say, okay, so I've got my intrinsic value. I'll take a margin of safety, and then I'll approach the business owner and say, look, I would be willing to pay this amount for your business. And, then they might say, oh, no, go away. And you go, okay, I'll pass. And they might go, oh, yeah, sure, I'll sell it to you. In which case you're like, okay, great. I know because I've done my discounted cash flow that I'll still get good investment returns. But again, the nuance around small business in particular is where I don't understand. Like what could you sell a private small business for, say a gas station in 10 years? I don't know what sort of multiple you can put on, say, free cash flow for like a gas station.
Yeah.
Do you have any insights around this?
I think the theory would probably be similar. I think it would just come back down to, compared to a large business that might have a really deep moat, is it reasonable that you can project forward? And can you actually come up with a reasonable estimation of cash flow in the future? Yeah. And it will differ from business to business. I think someone who has a small Shopify e-commerce business, for example, selling, t-shirts or something like that. If they've only been around for a couple of years, it's very speculative about what will happen for that business in the future. Our businesses, for example, I think would be, incredibly speculative about what
it'd be hard to
what
sell.
We're going to produce in the future. Whereas other types of small businesses, it might not be as speculative. I mean, I don't really know too much about some of the businesses you mentioned, but maybe a car wash has fairly stable revenues over time, or cash flows over time. I'm not sure, to be honest. It's not an area I've looked at, but that might be more stable than, say, a fast growing internet company, or an online business. So that's where where the difference in application would lie. It would be whether you could actually reasonably project forward profits, but then the theory would be the same. I think that, you want to value a business based on what profits it can produce, excess profits it can produce for its owners.
Yeah. Yeah, very good. All right. Should we properly crack on into the next question?
Yeah, let's do it.
All right. Well, let me ask you a couple questions now. This one, I actually answered this on a Q&A video that I made very recently, but I'm interested in your take on it actually. So, can the buy value of a stock that's found on, say, the 13F filing of a Warren Buffett, etc., couldn't you just consider that as the intrinsic value of the stock?
That's a interesting approach. I think
bit of a shortcut.
Yeah, I think. I mean, you could do this. So this would be kind of the process of cloning, just kind of copying some larger investor in their moves. I mean, there's a couple of limitations to copying 13F filings. I mean, they're 45 days after the period, so you're looking at a backwards view of when someone has purchased. But then you could I guess you could look at the price and say, okay, they bought at this price, so that must be the intrinsic value of the stock. I think when it comes to analysis, you should want to do your own research and do your own analysis and reach your own conclusion, because I think of intrinsic value not as this objective thing that we're all trying to calculate. I think of intrinsic value more as kind of a subjective view on what the business is worth, because what the business is worth to you depends on what return you want to make out of a business, and what return you want to make out of a stock could very well be different to somebody else. And therefore the value of that business is different for somebody else to you. If someone only wants to double their money over the next decade, and you want to quadruple your money over the next decade, then that business is worth more. They're willing to pay more. The person who's only wanting to double would be willing to pay more for that business, substantially more. So, and I mean, when it comes to the world of finance, as we said, there's so much differentiation on how you get to intrinsic value and what you think the cash flows of the business will be in the future. There are going to be so many different opinions about where a business will be in the future. And I think that if you're building your own portfolio, then you should want to reach those conclusions for yourself. That's kind of my opinion on that.
Yeah, that's exactly what pretty much exactly what I said in the Q&A video that I made. It's like, yes, I guess that's a bit of a shortcut. However, what they're, you got to remember if buy price by Warren Buffett on the 13F, that's his intrinsic value. That's his buy price based on his calculations, his what he wants to do with his portfolio. And that may not necessarily match up to your, what do you want to get? What do you want to do with your portfolio? Blah, blah, blah. So that's pretty much exactly what I said. All right. I'm going to roll on to the next one. You asked 2 in a row. I'm going to ask you 2 in a row. This one, I already know what you're going to say, but I'll ask it to you anyway. I think probably most people that listen to us regularly know what you're going to say. Do you think, Hamish Hodder, do you think it is a good idea to buy a stock during their IPO process?
Always. You should only buy IPOs. That's it. Just IPOs. That's it.
All right. Next question.
No, I think... okay, again, if you're looking at a stock at IPO, the same theory applies, right? If you can value that business accurately, if you can come up with a reasonable estimation of what cash flows that business will produce in the future, you can discount them back at 15% at a margin of safety, and at IPO, you can buy that stock at that price, then theoretically, yeah, you could buy that stock, right? The problem is, in reality, when you're looking at an IPO, is you're looking at a business that's usually quite young. Usually there's only 1 or 2 or 3 at the most, usually years of past financials to look at. So you have very little visibility on how the business looks in the past. And usually at IPO, the stock is extremely expensive because you're talking about a business that usually needs access to capital. That's why they're IPOing. They need money. So they're looking to sell their business for as much as possible. And the result of that is usually you're investing in a speculative business that's quite new, and you're paying up for that business. And I think the most gross example we've seen of that recently was Rivian, where the business is basically pre-revenue and they IPO'd at about, $80 billion or something like that. So, in that case, you theoretically at IPO, you could run through the numbers. And if you have 10 years of financials for that company for some reason, and you're able to figure out what it's worth, then theoretically, yes, you could maybe buy it at a discount, but in reality, it just never happens. I've never seen an IPO where the company has financial records for more than a couple of years. And I've never seen an IPO where the stock is not at an insane valuation. So
exactly right. All of those points. It's mainly just down to you can't be sure. You can make predictions, you can do valuations, but you're just not sure. Like, when they go through the IPO process, you will normally get a couple of years because they'll say, obviously, investors need to go off something, right? However, they won't give you 10 years. They won't give you 5 years. Normally, it will be 2 years, like probably 2 years tops. And so it's just not enough information. It's just so hard. You can look at IPOs that are happening at the moment and you go, oh, look, they're all shooting through the roof and whatever. And that's fantastic. But at the end of the day, I'd much rather... if you go along with that kind of mindset, I invest in IPOs because they all go up, it's only a matter of time before you get completely destroyed.
Yeah. And there's actually one type of IPO that I think is kind of interesting and that I think a lot of value investors go into, which is not the IPO of a new business, but one that's maybe been around for 30 years and is finally listing. A lot of people look at that and say, well, this business has been around for 30 years. We don't have the financials still, but it has a big brand name attached to it. I think Krispy Kreme is a good example of that. They IPO'd in the last couple of years, but it's a really old business. But the problem with those businesses is, they're only IPOing because they need access to capital. So you have to wonder, if we don't have visibility of 10 years of financials, what did the financials of the business look like that they needed to raise capital now after being operating for 30 years? Or the other reason why they would IPO is so that the founders can get out and get some cash out of the business, which is, another situation where you would wonder why now. So it all just comes back to wanting to have that history of financials so we know for sure that the business is a solid business with competitive advantages and a good track record, that sort of thing.
Yeah. Agreed. All right. Well, let's maybe do a couple more. Sorry,
Yeah,
I'm about to get hurried up because my parents are going to come and pick me up, and we're going to go to the Barossa Valley.
Oh,
So
very
that
nice.
might be happening. But we'll keep doing questions right up until they enter the door. So
All right.
let's see. We'll see. I don't know how long they're going to be, but we'll just find out.
I'll ask the next one to you then.
Sure.
How long should someone tolerate underperformance using an active strategy before deciding to switch to a passive strategy instead?
Yeah. I don't know if I have a good answer for this one, actually. I mean, if you've been trying your heart out over, say, like a 5-year period and you're severely underperforming, say, the S&P 500, then maybe that's an indication. But I mean, sometimes you might have periods, as an active investor, you might have periods of underperformance. But if you're still like, for example, you might see a great company that's just going on an absolute fire sale, and you buy in, but it continues to go on a fire sale and it keeps going down and down. You're like, oh, I've done my due diligence and this company's really solid. It's got a great competitive advantage. It is well managed. It's just being hit. Chinese stocks, they're all being hit at the moment. Some of those are really good businesses long term, but there could be a period of time where you're actually making the right decisions in terms of your active investing portfolio, but you do underperform. So this is actually, this is a really difficult question. I don't really know.
This is why investing is so difficult, because you can't really know if you're doing the right thing until many, many years have passed. That's the harsh reality of the investment world is, there's periods where everything is doing poorly or certain sectors are doing poorly. There's periods where business values are massively underrepresenting, the business prices are massively underrepresenting the value of those businesses. And I think for I don't know, my view on this is for the average retail investor, this is why most people, if you're unsure, most people should be passive investing. But if you do want to active invest, you should probably still have a combination of passive and active. Because you don't want to, you don't want to find yourself in the situation. And it can be very difficult to assess this as time goes on, but you don't want to be in the situation where you're massively underperforming through an active strategy for many, many years and giving up solid, consistent returns that you could have achieved as a passive investor. But there's no good, I don't think there's a good answer for this. I don't think so either. There's very successful investors who have a 10-year period where they do extremely well, and then after that they just do terribly poorly after that. You could ask the same thing. Well, in hindsight, why didn't they just stop after 10 years and just get out of the game? So very difficult question to answer. Most people will not outperform a passive strategy over a decade or more than a decade. So keeping that in mind, I think you have to just make a personal decision, how you're going to approach it. Is it 100% passive? Is it 90% passive and a bit active? How do you kind of allocate that is going to be up to yourself.
I think that's good advice, Hamish. All right. Let me ask you, what's the difference between a passive investor versus a defensive investor?
That's an interesting question. I guess so. I mean, a passive investor is someone who is strictly not trying to outperform the market. You're just trying to match the market, right? So you're buying something like an S&P 500 index where you invest in the 500 of the largest businesses in the US, and you just participate in the market, expecting that the market over the long term will continue to trend in the same direction as it has over the past 100 years for the US market. Same for the Australian market, about 6 to 8% or something like that after inflation. Defensive, on the other hand, I guess using kind of Benjamin Graham's definition of a defensive investor is someone who is active, but is investing in very, very safe, certain kind of investment opportunities. And I guess defensive kind of definitions will kind of change on what constitutes a defensive stock or a defensive investor. For some people, a defensive investor or defensive stocks are, very stable, consistent, mature businesses that have very, very similar cash flows year after year. You could also describe a defensive investor as someone who is just very, very careful and selective in what investments they make, but still invest in businesses that have the ability to grow. So I think it kind of depends on your definition, but
yeah. I think generally speaking, a passive investor, that's an easy definition. That is somebody who just buys ETFs that track the market and follows dollar cost averaging principles. Defensive investor, I think generally when defensive investors are brought up, they're people that are buying kind of the supermarkets, the companies that kind of do moderately well, but they always do moderately well. You know, when we're in the deepest, darkest recessions, people are still buying food. You know, the defensive stocks are kind of the stocks that tend to just their cash flows stay relatively consistent no matter what's actually happening in the economy, in the markets, that kind of thing. I'm trying to think of some other defensive stocks. Like supermarket is just the classic example.
Like utility businesses.
Exactly. Everyone turns the lights on.
Anything where people's buying habits are consistent over time, regardless of economic conditions. I mean, people don't really change how much water they drink or how much water their household uses. You know, when they're in a recession. Whereas people might change their travel habits when they. That's true. So that's kind of the difference between like a defensive and a cyclical, I guess. So, that's which one is better. I mean, it kind of again, I think it just comes back to it just comes back to what approach you want to have. I mean, most people I think will want to be passive investors because we have this huge long track record of you know, the US economy, for example, consistently growing over time due to innovation and businesses being competitive against each other. But some people will want to invest in individual businesses. And that's not going to be, you know, it's a very small fraction of overall investors. But I think you kind of just have to decide whether you want to be someone who is actively researching and diving deep into businesses to understand them, or whether you just want to participate in the market. Yeah.
All right. Should we do one more or should we wrap it up?
Yeah, we'll do one more. We'll do a quick one.
All right, let's do one
I'll read
more.
this one to you. Most efficient way to increase your circle of competence?
Yeah, that's a good question. I think we probably talked about this fairly recently as well. I think for me, because obviously circle of competence is kind of a weird one. You don't ever want to drift outside your circle of competence. That's what you always hear. Stay firmly within your circle of competence. Don't ever drift. But at the same time, surely as investors, we should be trying to expand our circle of competence over time. So I think for me, this is just the way I do it. I don't know if it's the most efficient way, but maybe it's the most efficient way for me, is I have my circle of competence is really just what I'm interested in, whatever I'm interested in, I go into more detail on. But really, I think once I'm, say, in my circle of competence, I'll just read books or listen to audiobooks and listen to podcasts as well that are kind of just general, or they might, for example, I read a book specifically on Alibaba, and that gives you insights into, you know, not only Alibaba's business and not only e-commerce, which might be in someone's circle of competence, but then it gives you insight into the cloud computing part of Alibaba's business. And then you go, oh, okay, that's really interesting. I was interested in e-commerce, and now I'm starting to learn about how Alibaba have incorporated cloud computing into their business model. And you kind of just learn like that. I think it's you always, when you're trying to expand your circle of competence, you always want to stay within things you're interested in. But I think once you can skirt around, say, social medias in your circle of competence, you can read books, you can you can listen to podcasts, you can, you know, keep up to date with what's going on in the news, and you can start to pick out things that are still within social media, but also start branching out into something different. Maybe it's just the internet in general. Maybe it's, you know, virtual. If you are in Facebook and you're like, oh, it's just advertising, it's social media advertising. They're like, oh, okay, now I'm interested in virtual reality. They've got Oculus. Do I start looking into that? I don't know if that's the most efficient way to increase your circle of competence, but I feel like that's how I naturally do it, is that I'm starting within my circle of competence. As I just learn more, kind of the edges start to get a little bit wider, but I'm by no means an expert in anything. So I'm always just trying to consume as much info as I can, really.
Yeah. Yeah, I agree with everything you said. I think the only thing I would add on top of that is just reading as many annual reports as possible. You'll pick up so many little things about how different businesses operate in an industry by just reading annual reports and how different.
That's like Nick Sleep. Didn't he just say he just churns through them?
Yeah. Just as many as possible for as many companies in that area that compete against each other as possible. And you'll learn how they've changed over time, what things they do differently, what things they do the same. And that will give you a really deep understanding of a particular area.
All right. Very good. That was great.
Yeah.
What an episode. That was actually a really good episode. I didn't realize we'd spend so much talking about DCF at the start, but, DCF. This is living.
No, that was fantastic. I didn't realize we were going to actually go for an hour. This is it's been really good.
Sorry, I'm dumping this on you. Actually, no. When this podcast is edited, send it to me. I'll review this one. I can do it.
No, that's all right. It's fine. Speaking of when it's edited, though, we should give a big thank you to Andrew, our editor.
Thank you, Andrew.
Who's been editing our podcast for what now? Probably close to 2 years, if not over,
probably 2 years.
Probably about 2 years. So
absolutely, yeah.
He always does a terrific job. So big shout out to Andrew for helping us out and helping us to
thank you very much,
done.
Andrew. Yeah. Very much appreciated.
Yeah, and thanks to everyone who's tuned in to the Young Investors podcast throughout this year and throughout the few years that we've been doing this. We always enjoy coming back every single week and just kind of having a yarn, having a discussion around what's happening in the finance world on a bunch of different topics around the world. So thanks everyone for making this possible by tuning in every single week, and especially
your support is appreciated.
Yeah, and especially the people who support us through Sharesight, for example. But it's basically just Sharesight. So tuning in, Sharesight. Thanks everybody for helping us do this, and I hope everybody has had a wonderful Christmas and is going to have it's New Year's Day now, so had a wonderful New Year's Eve. New Year's celebrations.
Get the fluids in.
Get the fluids in.
Yeah, Hydrolyte's good.
Exactly right. So we're looking forward to another jam-packed year of the Young Investors podcast and everything else we do. So we hope you'll stick with us over the next year. Thanks, Brandon, for joining me throughout this year. We'll try and
it's been a good year, hasn't it?
Yeah, we'll try and fit in some more live podcasts throughout 2022. 2022 is that what we're up to?
Yeah, that's where we're up to. Yeah, it's getting close.
Yeah,
we'll do it. We'll be able to do it. Hopefully in a couple of months. We'll have to catch up a few times. Come to Canberra. I'll come to Melbourne. We'll have a good time.
Yeah, exactly right.
All right, perfect. Thanks, guys. Thanks very much for all your support. I reiterate everything Hamish was just saying. Thanks for the support. It's been a great year, and let's have another great year in 2022. So with that said, we'll see you next week.
See you guys.